Ray Dalio warns of U.S. debt crisis. Within 3 years as Bitcoin rallies, Ray Dalio, the founder of Bridgewater Associates, told followers this week that the United States could face a debt crisis within roughly 3 years, and he tied that risk directly to Bitcoin's recent run. The comment, amplified by Cointelegraph in a post on August 24, 2026, frames the current rally not as a speculative blip, but as markets starting to price in fiscal strain. Bitcoin traded near $76,969 as of August 24, 2026, up 0.9% on the day and 21.36% over the past week, according to CoinMarketCap data in the accompanying market snapshot. Ether was around 2,144, up 2.6% on the day and 28.75% for the week. The Crypto Fear and Greed Index sat at 78, deep in greed territory. The case Dalio is making, Dalio has spent the past 2 years warning that U.S. federal borrowing is on an unsustainable path. His argument is mechanical rather than partisan. When a government owes more than it can comfortably service, it eventually has to choose between cutting spending hard, raising taxes hard, or letting the central bank absorb the debt through money creation. The third option erodes the value of the currency, and that is the scenario that tends to push capital towards scarce assets. Bitcoin's fixed supply of 21 million coins is the reason it keeps showing up in this conversation. If investors expect the dollar to lose purchasing power faster than official inflation figures suggest, an asset that cannot be printed becomes a hedge rather than a gamble. That is the link Dalio is drawing between a possible debt crisis and the price action of the last week. A rally with macro fingerprints. This is not the first time in August 2026 that debt worries have moved the market. Bitcoin jumped 21% earlier in the month after a Treasury buyback plan revived debasement bets, and the current move sits on top of that. The 7-day gains are broad. XRP is up nearly 47%, Solana up around 24%, and BNB up roughly 15%. A rally that lifts the whole asset class, rather than one token, is more consistent with a macro driver than with a single project's news. Still, a 3-year window is a forecast, not an event. Dalio is describing a risk he sees building, not a dated catalyst. Traders reacting today are pricing a probability, and probabilities can reprice quickly. The same fear and greed reading of 78 that signals conviction also signals crowding, which historically raises the odds of a sharp pullback if the macro narrative stalls. The takeaway for people holding crypto, for anyone spending or saving in crypto, the debasement thesis cuts two ways. A weaker dollar strengthens the case for holding a portion of savings in Bitcoin or in dollar-pegged stablecoins that at least earn yield, and it makes self-custody options more attractive to people who do not want a bank or exchange standing between them and their money. It also makes the mechanics of actually spending crypto matter more because a hedge you cannot access easily is a weaker hedge. That is where the plumbing comes in. Cards that let you spend directly from your own wallet or that pay cashback rewards in crypto turn a long-term store of value into something usable day to day. The trade-off is fees. The disclosed rate is rarely the full cost. Network spread of roughly 0.5% to 0.9%, a conversion spread at the point of sale, and gas on top-ups all stack. In a debasement scenario, holding the asset is the point, so cards that avoid forced conversions or offer zero foreign exchange markup protect more of the thesis than high-fee alternatives. None of this validates Dalio's timeline. His 3-year call is one macro view among many, and the current greed reading says a lot of capital already agrees with it. This is analysis, not financial advice, and a crowded trade is exactly the kind that can reverse hard on a single strong jobs print or a hawkish Federal Reserve meeting.